Good morning. David Schill, Catapult Wealth Partners, with the market update for the week of September 6th. Hope that you and yours had a lovely and restful Labor Day weekend. Well, the markets were anything but restful last week, and we had some economic news that came out that certainly added to volatility in the financial markets. The unemployment rate nudged up to 3.7%. On the August employment report that came out Friday morning. We had the two-year Treasury actually closed at a 15-year high of 3.5%, and the U.S. manufacturing PMI came in at 51.5, which was down about 0.7% from July, so a relatively weak number. In the week ahead, we have the August services PMI that comes up. That's the manufacturing index. We'll see what happens with consumer credit. And the OPEC meeting that just ended had the impact of slightly tightening oil supply marginally, which we'll have to see what the fallout of that is going to be during the week ahead. Financial markets, as we said, were incredibly weak during the last week leading into Labor Day. We had the S&P 500 index was down 3.23%. The Russell 2000 small cap index was really the significant loser of the week, down 4.7%. The International Developed Market Index, the MSCI EFA Index, was down 3%, and emerging markets down 3.41%. The tech-laden NASDAQ was down 4.18%. So what we really saw was during the whole of the month of August, we saw a lot of the give back of the significant gains that we achieved during July. But fortunately, we have not yet tested those June 16th lows that we made, which is really a good sign as far as the market is concerned. As we've said to our clients in our recent quarterly review meetings, is that we don't know whether the June 16th low point was in fact the low point of this cycle, and that the rally off that low was not just simply a bear market bounce. Time will still tell, but what we do know is that the fall is going to be particularly volatile, and investors definitely need to keep their seatbelts tightened. We know that we have a lot of things to kind of digest. We have an energy crisis, particularly in Europe, going on, which is not easy to deal with. We have China that is still entering lockdowns and moving from city to city with their zero COVID policy. And of course, public enemy number one on a global basis is inflation. And we know that central banks have actually said that they are laser focused on taming inflation and bringing it under control. And they will do this even if it sacrifices some growth as well as the labor markets to get it done. So we do expect during September, we expect the Federal Reserve to hike interest rates. We think possibly 75 basis points is probably the most likely scenario. And then we think we'll still have another two rate hikes before the end of the year, possibly one of 50 basis points and one of 25. Stay tuned, stay invested, don't panic, and remember, we are only a phone call away. Have a great week.